Hello, everybody, and welcome to the 2022 One Sustainability Conference, our annual global sustainability event. We now have the pleasure to welcome Nidhi Chadda, Managing Director, ESG and Climate Solutions at TRC Companies. Nidhi will tell us more about deciphering the value of S in ESG. Nidhi, thank you very much for your presence, and I hand over to you.
Great. Thank you, James, for the opportunity, and look forward to discussing a very important topic. So let's first start with defining the S and ESG. It's really been an age-old factor. Whether we look at the Civil Rights Act of 1964, the UN Guiding Principles on Human and Social Rights, UN Sustainable Development Goals, and the UN Global Compact. Regardless, we've seen this issue where human rights has been top of mind, whether it's been at the civil rights standpoint from employment discrimination and addressing that, or it's been around having concrete actionable steps to deal with human rights abuses. Yet, when we look at the overall map of UN Sustainable Development Goals, we see all 17 goals, all of which have been utilized as being part of aspirational goals and targets for both companies and for investors. And of those, many of which are focused on social factors. Looking at these are just a snapshot of what is relevant on human and social factors, and there are other topics on the environmental side that are also intertwined. But given how important the age-old factor is for S, we first need to take a step back and think about how to better define it, as many folks consider the social factors in very different lenses. First of all, for level setting, for purpose of this presentation, S is really about people. Whether we look at employees, community, consumers, supply chain. Social factors are everything from human rights, labor issues, DEI, workplace health and safety, product quality and safety, data privacy, and community engagement. And really the scope has widened over the years as businesses and markets are more interconnected, and we are seeing technology become more and more important, and we've seen the growth in the value of the intangibles. And COVID, along with a lot of other social movements, have really shifted on how we view the S side of the equation. And S really is the underpinnings of what defines organizational resiliency. In some cases, many people believe that S should really stand for not social, but stakeholders, as it impacts communities from a human rights perspective and engagement perspective. It impacts employees, definitely from a human and social standpoint, but also even extending into engagement, DEI, health and safety. And then it focuses also on the value chain and consumers. And consumers can be even more far-reaching in thinking about data privacy and security, and thinking through access, affordability, and product quality and safety. Even product labeling has become more and more pertinent. So really S stands for that relationship between a company and its people, and really all the institutions around it, which is why some people often defer to this as representing stakeholders. Yet so universally relevant, but it's just the hardest one to assess. And why is that? Well, 51% of investors per a recent survey indicated that the S factor is very difficult to assess and integrate into their analysis. So how do we take what is considered these age-old concepts of human and social capital practices, go ahead and track data and quantify the impact? Well, we continue to see the importance of these social factors just grow. Looking at the 2022 proxy season, we saw a significant uptick in social proposals, nearly doubled. In particular, we saw an uptick in certain areas, civil rights, racial equity audits, labor issues, political lobbying, and contributions as being top of mind. The chart on the right side shows the various areas across the shareholder proposal type where we've seen the greatest increase. And what's also been interesting is that the DEI-related proposals have also more than doubled this year. And we've now seen 21 proposals that went to vote, with an uptick in support of 43% versus 34% last year. So that momentum continues to grow. It's still very universally relevant. We're starting to see an increase in data. But if the impetus is so strong, what really are those challenges of just putting this into practice? Well, first, let's start with the lack of standardization and data availability. The biggest challenge has been that companies and investors are collecting data and looking at data in various different forms. And this is, of course, a challenge we've seen on the environmental side as well, where data infrastructure and collection can vary, whether we're looking at qualitative or quantitative data, specifically as it pertains to social factors. We also have limited comparability. The challenge here is that there are not necessarily one or two frameworks per se that are utilized for all collection of social data, which makes it challenging from a benchmarking standpoint. And lastly, there's inconsistency across ratings. The inconsistency across ratings it really stems from the lack of one solid definition that companies can use to compare and benchmark their own practices, and investors can utilize as well. This confusion has led to a lot of ratings having different views on specific companies, and it's made it very challenging to really assess a company's overall social factors and level of potential improvement that they could continue to drive. But with those challenges, we do see some potential solutions. And these solutions are the answers to the data that we are looking to gather in a more consistent and more transparent manner. So with the potential solutions, lack of standardization across data collection, we are seeing more and more companies now take the EEO form, and which is a mandatory annual data collection form that public companies will have to submit demographic data, are now being utilized and put onto websites, and companies are disclosing this publicly. We're also seeing quality improve because of technology. Technology is improving the volume, it's improving the granularity of data, and it's helping to drive some consistency. We're also seeing more comparability across new frameworks that are being introduced, whether it's the Impact Weighted Accounts Initiative or the ESG Data Convergence Initiatives. The Impact Weighted Accounts Initiative is essentially linking the line items from a financial statement and taking it a bit further to understand the impact to society and environment. The ESG Data Convergence Initiative, which we'll get into shortly, is really helping to drive transparency and consistency in the private markets. And it's helping to drive that accountability as we have a comparability across the various metrics that we're looking at. And lastly, we have the inconsistency across ratings and methodology now being addressed by greater consolidation across ESG frameworks and methodologies. Now, we've all seen a lot of data that's been published more recently about how there is a link of social factors to driving financial performance. There was research done by CapChase, which looks at non-dilutive capital for recurring revenue businesses, so essentially looking at startups, particularly in the software space. And it was interesting to see that those companies with higher ARR had 10% more female executives. We've seen studies from Credit Suisse, McKinsey, and also from Wall Street Journal, all pointing to the same conclusions. Women representing more than 20% of managers have seen greater share price increases over the past decade. Looking at the company performance over, of course, an extended period of time, McKinsey studies have also found something similar, where we've seen a 21% likelihood of outperformance. And then lastly, we've seen the Wall Street Journal also comment on 20 most diverse companies, showing an uptake on stock price return. For many of you who may not be familiar, Just Capital Rankings is actually a very renowned rankings that's done by a nonprofit affiliation that essentially looks at companies based off of key priority issues by stakeholders. In other words, they'll actually take a survey of what is relevant to the American public today, and then have companies fill out a survey to identify exactly what companies are doing on those specific issues. And interestingly, what we have seen is a significant spread between the top 10 performers, or the top 10 companies that are ranked on Just Capital, versus the bottom 10. It's a 58% versus a 13% spread, which is pretty significant, just given that companies who are able to best manage their key social and business issues, as we've seen on the right, are able to outperform pretty significantly. So with all that being said, as we are seeing more and more data being collected, and we are seeing more metrics out there, how do we put this all together for companies to really decipher the value of the social factor? Well, I would suggest a four-pronged approach. One is identifying, first of all, these S factors across the value chain. What are the social factors that are relevant across the chain? And I'll showcase a quick example of that. Next, we get into the assessment of whether these social factors are a risk mitigator or a value creation opportunity. Then look into quantification. Can we quantify the risk or the value creation impact? And lastly, can we track KPIs to measure progress? So just like we look at environmental factors and look at the impact across value chains, we should equally focus on key social factors to define risk and long-term value creation opportunity. Now, there are some frameworks that are increasingly putting metrics out there which are helping to improve the comparability. We'll start with the SASB framework as a key starting point. SASB, which is the Sustainability Accounting Standards Board, essentially has a framework that is utilized very consistently across 77 industry standards. And you'll see on the left side that human capital and social capital are top of mind with respect to some of these key metrics that are identified across these industries. So this is a great starting point, not only for public companies, but for private companies. And because it's linked to financial materiality, it's utilized for the investors as well. And what we are starting to see is that beyond the SASB framework, more and more companies are not only utilizing frameworks like SASB, they also are starting to incorporate D&I metrics and some relevant human capital management metrics. So we are starting to see an uptick in the data that is being released, driven by stakeholder focus, competition for talent, and just the growing knowledge about how relevant HCM is to the overall financial performance. And now that we're starting to see this uptick of data, the frameworks that are available, and the data that's being released, we still have a fair bit of work to be done. But as you can see on this chart here, looking at the human capital metrics as well as other ESG metrics, we are starting to see greater prevalence of data. And now that these factors are, many of which are quantitative, some are qualitative, but even with the quantitative ones, we are starting to see an uptake in terms of what companies are disclosing. So now that we're seeing the data collection move in the right direction, what we need to see more of is companies to assess, quantify, and track essentially these KPIs, so we can better enhance and develop some of the programs and have targets out there that are actually credible. And similar to the challenges we see in the environmental side, credible data and having that consistency is critical to defining those targets. One of the ways that we are seeing this being resolved is through the EDCI, which is essentially the ESG Data Convergence Initiative. It was a partnership of private equity firms that were committed to streamlining what has been a very fragmented approach to collecting and reporting ESG data. And now the goal is to really overcome this by looking for consistent ways to benchmark positions, not only across portfolio companies, but helping general partners assess their risk across their overall portfolios. And the ESG Data Convergence Initiative, it focuses on 4 key areas from a social factor standpoint, listed here: diversity, work-related injuries, net new hires, and employee engagement. And in addition to that, also covers greenhouse gas emissions and renewables. But the goal here is really to find a way to consistently collect the data for the private companies and to guide them on how we can benchmark this in a very careful and transparent manner. And right now, the EDCI is picking up tremendous amount of momentum. We have 250 GPs and LPs representing more than 24 trillion in assets. And this was spearheaded by Carlyle and CalPERS. So as I mentioned, there's that 4-pronged approach to identifying and deciphering the value for S across the overall value chain. So first, we'll start with taking a look at the broader value chain. It's important to look at not only the environmental factors, but looking at the social factors to see where exactly they sit across the chain, upstream through downstream operations. And then looking at each and every one of those levers and identifying where the risks could be sitting and where are their value creation opportunities that may not have been thought about in a more granular fashion. So we first want to lay that out and identify those social factors. Well, social factors, as mentioned as step 2, is they could be a risk mitigator, but they could also be a value creation driver. From a risk standpoint, there could be anything from human rights violations, labor relations issues, supply chain risks, cybersecurity, of course, becoming more and more prevalent, and product recalls. All these can really negatively impact a company's license to operate, and many of these factors can be quantified. But S factors can also be a value creation driver. From that standpoint, we could look at improved retention and hiring, engagement and productivity upticks, business growth through social innovation, which we'll go through a few examples of, and broad understanding of consumer preferences and just having an overall better sense of brand purpose. So value creation is a longer term lever with respect to social factors, but increasingly a more important one. And social factors can drive revenue growth, cost savings, and or improve overall cost of capital. So it's important to really understand these social factors, not only from a long-term tail risk standpoint, but also as a value creation driver over the long term. And when we look at some of these examples, when we think about first from a risk standpoint, a lot of these factors can be quantified and frankly have been quantified. So we saw an example very recently in 2020 where an online retailer had some issues with its supply chain, and it was published that by one of the news media outlets that the workers in one of their factories was actually being paid well below minimum wage. And this also resulted in more articles coming out and folks recognizing that workers were actually working without proper equipment during COVID. In just 1 week alone, this company lost about $2 billion in market cap, just by way of the supply chain issues, and then coupled by greater concerns around workplace health and safety. And so we are starting to see the markets react to these type of situations. And it's important to think about, when we are looking at those risk factors, if we can quantify that tail risk and what the implications could be. On the flip side, when we look at value creation opportunities, we also will see in many of these levers being able to impact not only driving revenue growth, but improving the overall cost picture and overall cost of capital through reducing risk. And this is just one framework that we have utilized, where we are looking at everything from company representation and management leadership representation, all the way down to more complex topics such as human capital and training, recruitment, hiring, supply chain, and societal impact. And what this table shows you is that many of these levers, when we look at the actual KPIs across various social factors, could have a multiple impact on thinking through what that optimization of human capital could be, how these factors could reduce risk, and could they actually also improve revenue growth over the long term. So it's important to consider all these factors from the lens of a value creation as well. Just to put this in perspective, one example that I wanted to call out was with respect to supplier diversity. Now, this is one that may not be thought about as having an impact across the levers. But there was a situation with Nestle India when they established a supplier development department. And this is a topic that's coming up more and more with companies. So it's important to kind of assess exactly what this could mean from a social factor standpoint and how to quantify it. So in this particular case, the company had wanted to promote more sustainable production and processing. They wanted to achieve compliance with local regulatory laws. They also wanted to increase cost savings by increased localization of imports, and just to overall create a wider, more flexible supply base. With respect to that, not only did they increase local sourcing of materials and reduce their single supplier situation, so therefore reducing the risk in the overall supplier program, they also were able to find new suppliers that met their audit terms, and they saved over 10 million just on this one program alone. And this was just one country. They then took this initiative and replicated across the board. And why this is important is that it actually touches upon all the levers of risk mitigation and value creation. One, it increases competitiveness by closing out the food safety and quality gaps. Two, it increases cost savings. And then lastly, it improves the risk profile by attracting a wider and more flexible supply base. So this is just one of many examples where how all the factors of looking at the risk side of the story as well as the value creation can all be put into place in one given social factor. And it's important to not only look at the social factor across the value chain, but identify the risk, the value creation, and then quantify that impact where appropriate. And lastly, just to end on one important note on DEI. So I know there's been a lot of case studies on diversity, equity, and inclusion and what that could mean on financial performance. So just to bring this case study to bear here, one example would be just taking a high-level look at what could mean for a company if they were to improve DEI practices. So as an example, if a company were to improve these practices long-term, there's been evidence that has suggested an improvement in overall innovation. So we've seen improvement in patents, new product offerings, just improved cognitive diversity, driving a more interdisciplinary approach towards problem solving. That's been the first layer that's been really helping to drive DEI practices and overall financial improvement for a company. Next, we looked at teamwork and productivity. We've seen an increased ability for teams to work more effectively together. This collective intelligence, just having a safe environment, has also been critical to thinking through and brainstorming and improving overall teamwork and productivity. We've also seen increased job satisfaction, lower turnover, enhanced employee engagement, all creating a more inclusive environment. And then we've seen more analysis being done on underserved markets, and that helping to drive overall market share and just having an improved overall understanding of consumer needs. This has all led to improved and enhanced reputation for companies. They're not only able to assess their internal policies and practices, but they're able to mitigate risk and maintain legal compliance, which in the long term not only saves costs, but can drive revenue growth and improve their cost of capital. And we've touched upon this already, but many studies have indicated how DEI is now pointing to a lot more improvement, not only on revenue, but also on profitability. And we've seen that study across the board by a number of firms. Now, if we start thinking about the levers, we can think of it in a couple of different angles. Well, one is that if we want to define this for revenue growth, cost savings, and for improving cost of capital, we have seen many companies where they have been able to identify and look for underserved markets where perhaps they haven't thought about that overall as a company, and they think there's more opportunity to target a given market. So we've seen that example with P&G, where they were able to create new hair care brands. We've also seen a similar example in the world of disability, where Nike had taken the feedback from a teenager with cerebral palsy and utilized that to create a sneaker that not only is designed to accommodate disabilities, but actually lead to a product that's better for everyone. And it's helped to generate long-term revenue growth, not to mention targeting 15% of the overall base of individuals who have some form of disability. And then we also look at DEI as it links to cost savings. For example, we have seen many studies where improved employee retention, less turnover drives overall competitiveness, but it also helps to save costs. And if we have increased employee turnover, we could see higher costs due to business disruption, increased expenses due to additional hiring efforts. There was a study recently done by Deloitte where they looked at millennials and they noted they were not very satisfied with what companies were doing on societal impact, creating a diverse and inclusive environment, and just a commitment to sustainability. And all this could be a potential risk for companies if they don't improve employee retention and improve their turnover. So this could be a lever on the cost side. And then lastly, we're looking at the reduced cost of capital. There was a study that was done, a representative case study done by the PRI, where we looked at investors having reduced the cost of capital to account for the improvement in governance. So as investors are getting more and more focused on diversity-focused topics into their research, we are starting to see more analysis being done on improving cost of capital and what this could mean for overall baseline valuations. And generally speaking, this, of course, is also critical to organizational resiliency. So really, in summary, when we think about the overarching theme here, it's really about not only considering social factors from a risk standpoint, but a value creation driver lens, and then looking at the revenue growth, cost savings, and cost of capital, all as being all encompassing to how to decipher value from the social factors more broadly. And for those who are interested in continuing this conversation offline, we also offer a DEI scorecard, which essentially looks at a lot of the metrics across the categories I outlined earlier in a range of complexity, and then identifies what are those key metrics based on detailed research that's been done on public and private institutions. We craft a scorecard to help companies assess where they are. And this is also utilized for investors as well who want to better understand the DEI exposure for their given portfolio. And happy to answer any questions about this in the Q&A or offline as well. And for that, I thank you for all your time.
Well, Nidhi, thank you so much. It seems that the issue of S is so essential because we live in a world where there are centuries of traditions, biases, prejudices, and companies that operate in these societies are affected by them. We know all the examples, and by giving a technique with the right methods, the right issues, the right figures, you can perhaps create a bigger change in society. Because by doing this, it's not just the corporation itself, it's all of society that will have to evolve and change. So I think this is an excellent undertaking. And I was just wondering, do you see many cases where corporations are held back because of the attitudes and the prejudices in the societies where they operate?
Yeah, it's a great question. So a lot of times what we see is that culture is always a starting point to fixing any issue. And we still see a lot of room for improvement in terms of training and what needs to be done on the actual practices level. So we may see the right human and social capital practices in writing, but then the question is, well, how do they get translated into actual principles? And that oftentimes stems about the culture. And that culture could be both in public companies as well as private companies. So we have seen a challenge where even private companies are early in terms of adopting cultures and trying to figure out how to navigate through this and build accordingly. And then public companies that may not have had the culture for this, they need to backtrack and figure out, well, how do we assess some of these issues that we're seeing internally? And sometimes that often happens where they have to do employee engagement surveys and recognize, well, we're starting to see some of these challenges across groups. And it's really important for them to create a safe environment so they can hear feedback from employees as well, which is critical. But definitely starts with the training and the employee engagement and survey work to identify any concerns on the cultural standpoint.
Excellent. This is really moving in the right direction. And I hope it has a huge impact, even more than within corporations, because there's so many social issues that we need to deal with. Anyway, Nidhi, I thank you so much for your presentation. It's very informative and very helpful.
Thank you.
And we're proud to have you as part of our group here and look forward to seeing you again soon.
Thank you so much, and happy to share any feedback afterwards, and anyone who's interested in diving into some of these topics, as we have a lot of interesting data, happy to share that afterwards.
Excellent. Thank you so much.
Thank you. Bye.
Bye.